Hi, welcome to Nepi Invest. Welcome to my last video of 2020, and I'm going to do my second last video on my ASX stocks to watch in 2021 series. And the theme for today's video is growth. So these are companies that have been growing very strongly over the last few years at least. Some of these have been growing strongly for 15 years. I think the question is, are these companies overvalued or expensive? And I think the general thinking is they are, but I would actually sort of beg to differ. And the second question is, can these companies continue to grow in their future? And there's absolutely no reason to suggest they will not. But I won't answer that question in itself, but I'll just look at some of the valuations of these companies and how I look at the valuations. And the first company I'm going to look at is Objective. So on the left, I've got the chart for the last year. And the chart shows that this company has been doing very well, going from $6 at the end of last year all the way up to $12, above $12 anyway. So it's doubled its share price in the last year or so. So this company has a market cap of 1.2 billion. Revenue of 70 million and operating cash flow 29 million. If you looked at that in isolation without knowing the growth profile of this company, you would think they're expensive. Now, I'm going to show you why I don't think it's expensive right now. So on the table, then down the bottom there, or in the middle there, I've got 3 columns, or 4 columns, but the 3 main columns are I'm looking at the compound annual growth rate of the last 15 years, the last 10 years, and the last 5 years. I'm looking at the growth rates of revenue, profit, and operating cash flow, and I'm just comparing that to the share price growth. So what I'm looking for here is I'm looking for the share price to be mirroring either the operating cash flow or the revenue. And you can just see in the last 5 years, the share price growth has been 28%. And the operating cash flow has been 28%. So the share price has been mirroring the operating cash flow over the last 5 years. So based off that, I'd say this is fairly valued, this company. What I'd be looking for here for a good value would be if the share price growth is actually less than the operating cash flow and the revenue growth. Or if a company is expensive, I'll be looking for where the share price growth is substantially more than the operating cash flow growth or the revenue growth. So in the Objective situation, you can see revenue hasn't been growing that strong, but because they've got increasing margins, you're seeing the operating cash flow growing at a stronger rate and the profit growing at a stronger rate than the revenue growth. So just based off the last 5 years, I'd say it's fairly valued. If you look at the last 15 years, the operating cash flow has been growing at 19.6 and the share price only 12.6. So there is possible argument here to say that there is some room for the share price to maneuver upwards just based off the fact that the share price growth hasn't been in line with the operating cash flow growth over the last 15 years. So I'll leave it up to you to decide either way. But again, I would not call this company overly expensive, although I think a lot of people do think that. Nanosonics. So I do have a bit of history with this company. I've held this company in the past. It's been a good wealth creator for me. I did recently got out, well, not recently, about a year ago or so, I did get out in February. Now, market cap of 2.4 billion, revenue 101, and operating cash flow 23. You just see the chart, looked like it entered a downtrend in about June, July, and the share price got down to $5 by the end of October, start of November. Some good news came out, and we've seen share price rally from $5 to $8. It looks like it's gone into a good uptrend now. And when we look at the growth rates of the company, now, when I've got NA there, that means that the company wasn't profitable or wasn't operating cash flow positive 10 years ago. It's only become profitable and operating cash flow positive 4 years ago. That's why I've got those 4 in brackets in the 5 column. And you can just see the share price growth has mirrored the revenue growth over the last 5 years, around about 30 to 35%. And you can see the operating cash flow over the last 4 years, since they became positive, has been 63% per year. So if they can continue that sort of growth, which would be fairly hard and quite significant, you would say the share price has room to grow stronger moving forward. But even if they don't, even if that operating cash flow starts to grow a little bit, not as strong as 63%, if they can maintain revenue growth of 35% or between 30 and 35% over the next 5 or 10 years, we'll definitely see the share price grow stronger from here. So definitely have a bit of a watch list on Nanosonics share price or company, and it's another company I'll be looking to buy in at some point in the future, particularly if they can continue to grow at the rates they have been growing. So again, this company I wouldn't suggest is overvalued based off their growth rates. Technology One, so a lot of professionals and analysis would suggest this is one of the best companies or one of the best tech companies on the ASX. It's always featured in those sort of lists, and this is Technology One, ticker code's TNE. And one of the reasons why it's a very much favoured company among those people, among the professionals, is when you look at the profit growth rate for the last 15 years, compare it to 10 years and 5 years, it doesn't change all that much from year to year. So you can see the profit growth rates has been roughly about 12% per year. Revenue growth rates have been a little bit less than that, suggesting they have been increasing their margin, especially when you look at the operating cash flow growth, which has been between about 17 and 22%. In fact, in the last 5 years, the operating cash flow has been growing at 22%, which has been outdoing all the other metrics, including share price growth. So based off the last 5 years, you might be able to argue that the share price is a little bit undervalued just based off the last 5 years, the fact that the operating cash flow has been growing stronger than the share price growth. But if you go back 15 years, you can see the operating cash flow and the share price growth have been growing about the same. So I think what's been happening in the last 5 years is the operating cash flow has been catching up. Operating cash flow growth has been catching up to the share price growth. So I wouldn't call this company undervalued, overvalued. I'd call it fair value at this stage. And I think if they can maintain the growth moving forward, I think we'll start to see this company move into an uptrend in the future at some point. And I'll be waiting for that time to buy in. Next company is Altium. So the previous companies I've looked at, they've been fairly valued. Maybe you could argue undervalued. This is a company where I would definitely argue is overvalued. Again, share price hasn't been doing much in the past year. This is another company I've held for a long period of time in the past. It's been another good wealth creator for me, but the share price has been doing nothing over the past 7 or 8 months, but it's been going sideways, and that's one of the reasons I sold out. I put my money to work elsewhere, and I'll be waiting for uptrend to continue or recommence, and that's when I'll put in a buy. So this is a market cap of 4.5 billion. Revenue 268 million, operating cash flow 82 million. And one of the reasons I think this is overvalued is if you just compare the share price growth in any period of time, it's always been outdoing all the other metrics, revenue, profit, and operating cash flow growth. So if you look at the highest growth rate for revenue, profit, and operating cash flow, it's actually 40%, which is the last 10 years in operating cash flow. And the lowest for share price growth has been the last 15 years, and it's been growing at 40% per year, which is not too shabby at all. In fact, the last 10 years it's been growing at 80% per year. So I think what might happen in the next, say, few years is the share price growth, well, actually reverse it. The operating cash flow and the revenue, particularly the operating cash flow, has to catch up to the share price growth. So what we might see is the share price growth remain static for a while, what we've been experiencing the last 7 months, just so the operating cash flow can catch up. And I would expect there's not much to happen with the share price unless they can get some substantial growth in operating cash flow over the next few years. Next company is WiseTech. This is a company that did have a bit of a short attack against it a few years ago. I've never owned WiseTech, and I've always thought it was expensive. And I've always thought it was expensive until I did this video and had a look at some of the numbers. So market cap of 10 billion, revenue 429, and operating cash flow 130 million. I've only got data for the last 4 years because they've only been on the ASX for the last 4 years. But you can see the share price growth of 45% is very impressive, but maybe not quite as impressive as the operating cash flow, which has been growing at 57.5%, or even a profit 192% per year. It maybe suggests that the share price growth has been mirroring the revenue growth, but I think there is a chance it might start to mirror the operating cash flow growth, which is probably a reason why we're starting to see the share price grow a little bit stronger since August. So all these numbers actually are based off end of financial year 20, which is in August, and we actually have seen the share price go from $20 to $31, which would suggest the share price growth is starting to catch up to the operating cash flow growth. So I'd say this again is probably fair value around these levels. And again, I'll be waiting for maybe a dip, waiting for the share price to go sideways for a period of time before I start to buy in to WiseTech Global. The last company I'm going to look at is Xero. So me and Xero have had a history, yeah, very short history in the past. Well, of course, in the past. Can't have a history in the future, can you? But anyway, we've had a history going back, I think it was about 7 years ago. I held Xero for a very short period of time for like, when it was at $20, sold it at $30, thinking I was a genius to sell 50% profit, and I just saw the share price go up and up and up since then. So a market cap of 20.9 billion, revenue 766, and operating cash flow 214. Now, my argument with Xero is this is probably the best in August. So this is all based off August share price. In August, this was actually the best valued company out of a lot of these companies. And I think that's the reason why we've seen significant share price growth since August. Share price has gone from about $90 or so to almost $160. Now, so the last 5 years of data, we've seen share price only growing at 24% per year, which is okay. I mean, if my portfolio was growing at 24% per year, I'd be very happy. We've seen revenue growth at 42% per year, and operating cash flow only the last 3 years of the data, because they've only been operating cash flow positive for 3 years. It's been growing at 77% per year. No data for profit. They've only recently become profitable, and that's probably the last thing I look at is profitability. But just based off revenue growth and operating cash flow growth, the share price growth is quite a bit lower than those two metrics, and I think that's the reason why the share price has been growing stronger over the last 4 or 5 months. So the share price growth is catching up to revenue growth and operating cash flow growth. So I would suggest that, again, I think if there's a bit of a drop in the share price moving forward with Xero, that would be a good time to buy in. So I don't see any reason this company can't stop growing in the future. And that's true for all these companies. These companies have been growing for quite a few years at least, and there's no reason to suggest they won't keep growing. And if they do stop growing, I think the overall market in Australia is in trouble. So that's all I've got on this video of ASX stocks to watch in 2021, my final video of 2020. Hope you've enjoyed it. Have a happy new year. Only about 5 hours, 6 hours to go for me. Actually, I am doing a night shift tonight, so no partying for me tonight. But anyway, if you do need some financial advice, I'm not a financial advisor, but if you do need some advice, make sure you seek out someone who is qualified and can help your own circumstances when it comes to your finances. Otherwise, that's all for today's video. That's all for this year's videos. Have a good day. Happy New Year. Talk to you later. Bye.